The quiet edge, long-term thinking in a loud world. Over the years, I've found that the most valuable ideas in business and in life are not complex secrets, but simple truths that require discipline to execute. I want to discuss one of the most powerful of these truths, something I call the quiet edge. In a world that seems to get louder, more frantic, and more focused on the immediate with each passing day, I believe this edge is not just valuable, it's becoming rare, and therefore more potent than ever. Now, when I say edge, I want to be very clear about what I mean. I am not talking about a secret formula from a Wall Street quant, a piece of insider information, or a complex algorithm. I'm talking about an edge in temperament, an edge in perspective. It is an advantage available to every single person in this room, regardless of your profession or the size of your savings. It is the disciplined ability to think in terms of years and decades, while the world around you is screaming for your attention about what happened in the last 5 minutes. This loud world we live in is like a 24-hour news channel dedicated entirely to the stock market. It's a constant, overwhelming barrage of flashing ticker tapes, pundits shouting about game-changing news, and headlines that treat every single market twitch as a historic event. It's exhausting by design, and it's engineered to make you feel that if you look away for even a moment, you'll miss something crucial. It pushes you toward action, any action, just for the sake of feeling like you're doing something. The quiet edge is the ability to turn down that volume, to change the channel in your mind. It's about evaluating a business not by what its stock price did today, but by what the underlying company will be worth in 10 years. It's the wisdom to understand that the most powerful force in the universe, compound interest, doesn't work in a day, a week, or a quarter. It works over a lifetime. To illustrate this, I'd like to share a few parables with you. Simple stories from the School of Common Sense, all set in the world of business and enterprise. The parable of the two coffee shops. On the main street of a bustling town, two coffee shops opened at the same time. Let's call them Steady Brew and Buzz Beans. Buzz Beans was the talk of the town from day one. It had a flashy, modern interior, a menu with wild, trendy concoctions featuring whipped cream and sprinkles, and it launched a massive social media campaign with influencers. Every week there was a new gimmick, a loyalty program that gave away free trips, a limited-time unicorn frappuccino, buy one get one free deals. The lines were out the door. The local paper wrote about its incredible launch. It was loud, in every sense of the word. To an observer looking at any single week, it was the undeniable winner. A speculator might have looked at that initial frenzy and bet everything on its continued success. Steady Brew, right next door, took a different approach. The owner focused on just two things: sourcing the highest quality, ethically traded beans he could find, and training his baristas to be true craftspeople, to pull a perfect shot of espresso and steam milk to the ideal temperature every single time. The shop was clean and comfortable, but not flashy. The prices were fair, but there were no deep discounts or gimmicks. At first, his business was slow. People were drawn to the excitement and the deals next door. Some well-meaning customers even suggested he get with the times, lower his prices, or create a viral drink to compete. From the outside, it looked like a failing enterprise. But the owner of Steady Brew believed in his product. He understood a fundamental truth. While marketing and gimmicks could attract a crowd, only consistently excellent coffee could build a loyal community. He quietly invested in his relationships with his bean suppliers and his staff, ensuring low turnover and deep expertise. He didn't worry about the line next door. He focused on the experience of the customer in front of him. His was a strategy of quality and patience. After about 18 months, a predictable shift occurred. The novelty of Buzz Beans wore off. The drinks, it turned out, were overly sweet and inconsistent. The service was harried because staff turnover was high. It's hard to become an expert when you're constantly training new people. The deep discounts, while great for customers, had eroded their profits, making it impossible to pay for quality ingredients or retain good staff. The crowd thinned, and eventually Buzz Beans closed down, a victim of its own initial noisy success. Meanwhile, the customers who did try Steady Brew became regulars. They came to appreciate the reliability, the quality, the fact that their latte tasted perfect every single morning. They told their friends. Steady Brew's business grew, slowly and steadily, month after month. It became a beloved institution on that main street, not because of a loud launch, but because of a quiet, unwavering commitment to a simple, good product. The owner had built what I like to call a moat. In this case, a moat of quality and customer loyalty that competitors couldn't easily cross. He had the quiet edge. In the stock market, you will find thousands of Buzz Beans companies. They are the hot new trends, the story stocks, the ones with the charismatic CEO who is always on television promising to disrupt the world. They are exciting. And sometimes, for a short while, they make their early backers a lot of money. But building a durable investment is about finding the Steady Brew companies. These are businesses with a sustainable competitive advantage. It might be a trusted brand like C's Candies, or a proprietary formula, or simply a culture of operational excellence that is impossible for competitors to replicate overnight. They don't need a lot of hype because their product or service does the talking for them year after year. The quiet investor seeks out these compounds of quality. The parable of the two furniture makers. Let's consider another business, one that deals in a product meant to last, wooden chairs. Imagine two companies, Heirloom Quality and Fast Furniture Co. Fast Furniture Co. is a marvel of modern efficiency and marketing. They use the least expensive materials like particle board and thin veneers. Their designs are copied from the latest trendy catalogs, and they can get a new style to market in a matter of weeks. They sell their chairs at a very low price, and they sell millions of them. Their factories are optimized for speed and cost cutting above all else. Their quarterly earnings reports are often spectacular, showing rapid growth in units sold. To anyone reading the headlines each quarter, this company is a roaring success. The noise is all positive. Heirloom Quality, on the other hand, operates on a different timeline. They source solid, sustainably harvested oak and walnut. They employ master craftsmen who know how to join wood without a single nail, using dovetail and mortise and tenon techniques that have been refined over centuries. They finish each piece by hand with oil, not lacquer. They only make a few classic, timeless designs. Naturally, their chairs cost 10 or 20 times what a fast furniture chair costs, and they sell far, far fewer of them. Their quarterly reports are uneventful. If you looked only at the sales figures or the stock chart for any given 3-month period, Fast Furniture Co. would look like the clear, undeniable winner. It's the loud, obvious success story. The market often rewards this kind of noise in the short term. But let's adjust our lens to a longer view, say a 10-year horizon. A chair from Fast Furniture Co. might last a couple years before it wobbles, the veneer chips, and it gets tossed in a landfill. The customer's experience is fleeting. They are a transaction, not a devotee. To maintain growth, Fast Furniture Co. must constantly spend heavily on marketing to find new customers to replace the ones whose chairs are broken, and they must forever chase the latest design trend. They're on a treadmill, running faster and faster just to stay in place. A chair from Heirloom Quality, however, will last for generations. It will be passed down from parent to child. The wood will develop a rich patina that tells the story. The buyer of that chair, though they paid a high price initially, becomes a lifelong advocate for the brand. They will tell their friends, their family, their colleagues about the incredible quality. While Fast Furniture Co. is on a treadmill of customer acquisition, Heirloom Quality is slowly building a deep reservoir of brand equity and customer loyalty. Their sales are slow but steady, and their marketing costs are low because their customers do the marketing for them. Their business model is built for the long haul. The quiet edge in investing is the ability to see the immense value in Heirloom Quality. It's understanding that a company's durability, the longevity of its products, and the strength of its customer relationships are often more valuable than a flashy sales growth number in a single quarter. You're not buying a stock ticker, you're buying a piece of a business. And you want to own businesses that you would be comfortable owning for 100 years, even if the stock market decided to close down for a decade and not give you a daily quote. You invest in the fortress, not the fireworks. The parable of the town's general store now. Let's consider a story about how the loud world can create opportunity for the quiet thinker. Imagine a small, prosperous town with one general store. For 50 years, it's been run by the same family. They know everyone by name. They stock what people need. They give credit to a family when the harvest is bad, knowing they'll be repaid. The profit margin on any single item is modest, but the business is as steady and predictable as the sunrise. It throws off consistent, reliable cash flow year after year. It's the definition of a durable enterprise. One day, a big national discount chain announces it's building a massive, gleaming store on the edge of town. The news is everywhere. It's the lead story in the paper and the only topic of conversation at the local diner. The discount chain promises everyday low prices on everything. The narrative is powerful and loud. The days of the old, outdated general store are numbered. The perceived value of the general store's business, if you tried to sell a share of it, plummets. The future seems certain and bleak. The noise is overwhelmingly negative. The loud world would tell you to panic. The headline is clear. The big, efficient, well-capitalized competitor will destroy the small, sleepy incumbent. It's a compelling story that seems to make perfect sense on the surface. But the long-term thinker, the one with the quiet edge, would ask a different set of questions. He would turn down the volume on the panic and engage his rationality. He would do the work that others are too distracted by fear to do. He would ask, will people really stop going to the general store entirely? Is its value truly just about the price of a can of beans? He might realize that the general store provides something the discount chain never can: profound convenience, a sense of community, and decades of built-up trust. He might calculate that while the chain will undoubtedly take some business, perhaps the sale of bulk paper goods and laundry detergent, the general store's core business, the last-minute gallon of milk, the friendly chat, the trusted advice, the willingness to extend credit, will remain largely intact. He would see that the local monopoly on goodwill and convenience is a powerful moat. The bad news, while real, is not fatal to the long-term fundamental value of the enterprise. In fact, the panic might have created a situation where this wonderful business is now available at a wonderful price. Often, in the stock market, a similar phenomenon occurs. A wonderful, well-run company faces a piece of bad news, a lawsuit, a missed earnings estimate, a new competitor enters the scene, or there's a temporary problem in its industry. The headlines scream. The pundits pontificate. The stock price falls sharply, sometimes by 20, 30, or 40%. The loud world shouts in unison, sell. But the long-term investor, if they have done their homework and truly understand the business, quietly asks, has this news fundamentally and permanently damaged this company's long-term competitive advantage? Or is this a temporary storm that will pass? If the answer is that the moat is still intact, the brand is still strong, the customers are still loyal, the product is still essential, then a lower price for a wonderful business is not a danger. It is a gift. The noise of the crowd, driven by short-term fear, has created a bargain for those who can see the enduring value through the fog of the present moment. This is where the quiet edge pays off handsomely. The parable of the two mines. Let me give you one more story, this one about the nature of value itself and the patience required to find it. Imagine two mining companies, Shaft Diggers Inc. and Core Samples Ltd. Shaft Diggers Inc. is all action. They lease a plot of land, bring in massive equipment, and start digging a huge open-pit mine immediately. Within months, they're pulling ore out of the ground. They're shipping truckloads to the refinery. Their revenue starts flowing almost instantly. Investors can see the activity, see the trucks moving, see the income statement reflecting immediate sales. It is a visible, tangible, and loud operation. It gives the impression of immediate productivity and success. Core Samples Lytton takes a different approach. They acquire a large prospective plot of land. Instead of digging a massive pit, their team spend years, yes, years, methodically taking small core samples from hundreds of different locations across the property. They map the geology in painstaking detail. They analyze the data in quiet laboratories. To an outside observer or an impatient investor, it looks like nothing is happening. There is no revenue, there are no trucks, there are just bills for salaries and equipment. It is quiet, slow, and from the outside appears unproductive. A speculator would have grown bored and sold his stake after the first year of no visible progress. After 4 years, the story for Shaft Diggers Inc. is changing. They have already mined the most easily accessible high-grade ore. Their yields are starting to decline, and the cost of digging deeper and processing lower-grade material is becoming prohibitive. They are facing a long, slow, and expensive decline. The initial promise has faded. Core Samples Lytton, however, has now completed its mapping. Because of their patient, methodical work, they have identified the single richest vein of ore on the entire continent. They know exactly where to dig. They build one highly efficient, targeted mine shaft. It costs a fraction of the open pit mine, and it produces 10 times the output per ton of rock. Their profitability is immense, and because they understood the resource so deeply, their mine has a productive life of 50 years. The patient work of the early years is now paying off in a torrent of cash flow that will last for decades. The quiet investor is the owner of Core Samples Lytton. He understands that the real work of investing is not in the frantic buying and selling, which is like digging a haphazard pit. The real work is in the quiet, patient, and sometimes boring process of research and understanding. It's about doing your homework on a business until you know it as well as those geologists knew their land. You are building a map of its true value. This process doesn't provide the immediate gratification of a rapidly moving stock price, but it allows you to act with supreme confidence when you do, because you have identified a truly rich vein of value that others, focused on surface-level activity, have completely missed. The loud world is digging everywhere. The quiet investor drills in one precise, well-researched location. The parable of the 2 newsletters. Finally, let's consider a story about the information we consume. Imagine 2 investors, Clara and David, who both want to stay informed. Clara subscribes to every financial news alert she can find. Her phone buzzes constantly with headlines about the Fed, about unemployment reports, about what a CEO said in an interview. She watches financial television for hours each day, listening to the debates and the predictions. She feels incredibly informed, on top of every market-moving event. But this constant stream of information creates a pressure to act. She starts to believe she can time the market based on this week's news. Her portfolio is in a constant state of flux, churning with every new piece of noise. She is active, engaged, and loud in her own investing behavior. David takes a different approach. He reads a company's annual report from cover to cover. He reads it from 5 years ago and 10 years ago to see how the business has evolved. He might read the biographies of the board members. He ignores the daily headlines and instead focuses on a few key metrics. Is the company's return on capital high and consistent? Is its debt manageable? Does it have a durable competitive advantage? He makes an investment decision, and then he largely tunes out. He might check the company's quarterly reports, but he pays no mind to the daily gyrations of its stock price. His is a quiet, deliberate, and patient process. At the end of a decade, let's look at their results. Clara, despite all her activity and her feeling of being informed, has likely incurred significant trading costs and taxes. More importantly, she has likely been whipsawed by every trend and panic, selling in fear and buying in greed. Her returns are probably mediocre, a reflection of the noise she consumed. David, on the other hand, has made only a handful of decisions. But because he invested with a long-term horizon in wonderful businesses, he understood deeply. And because he allowed compound interest to work without interruption, his results are likely to be far superior. His quiet approach, his filtering of the world's noise, was his greatest advantage. My friends, the common thread in all these stories is the fundamental conflict between the apparent and the real. The loud world deals exclusively in the apparent, what's happening today, this hour, this minute. It's obsessed with the ticker tape, the quarterly report, the latest headline. It is a world of constant, frenetic activity that mistakes motion for progress. The quiet edge is concerned solely with the real, the underlying durable value of an enterprise that compounds slowly and often invisibly over time. It is a world of patient judgment and disciplined inaction. Your greatest tool in cultivating this edge is not a faster internet connection or a more powerful computer. It is your own rationality. It's the ability to tune out the siren song of the latest trend and focus on the few simple fundamentals that truly matter: the quality of a business, the integrity of its management, and the reasonableness of its price relative to its long-term earning power. It is about being a business analyst, not a market analyst, not a macroeconomic analyst, and certainly not a stock price analyst. It is a quiet, unexciting discipline. There are no shortcuts. There will be no parades for your most prudent decisions. But in a world that is increasingly addicted to noise and immediacy, that quiet discipline, the ability to think for the long term, to be greedy when others are fearful, and to be fearful when others are greedy, is the most powerful and most widely available edge you can ever possess. It is an edge that does not require you to be the smartest person in the room, but simply the most patient. And in my experience, patience is a form of wisdom that the loud world has largely forgotten.